Hello guys, welcome to EduTap. I'm your mentor Veer and I welcome you all in the lecture 5 of our banking awareness series. And guys, the topic that we're gonna start today is differentiated banks in India. So without wasting any time, let's get started. But before starting our today's video, if you are new here, please do subscribe to our YouTube channel where you can find the daily updated videos of the courses that we are offering. Moreover guys, if you want to download the free material that we are providing, you can check out our Telegram group, the link of which you can find in the description box. So guys, now it's time to start the video of the day. So guys, as the name suggests, differentiated banks in India. Differentiated, this means it is somewhat different to the already existing banking structure in India. Already existing banks in India. It is somewhat differentiate. So guys, we will try to understand what this differentiated banks actually means. Okay, and guys, one thing I would like to quote here is that this topic is quite important. In the previous year papers of the different exams, question has been asked directly. Okay, so whatever I mentioned here today, please try to retain that in your memory because a question can be asked in the future as well. So guys, let's try to understand what differentiated banks actually are. So let us go into the brief historical background of this differentiated banks topic. So guys, there was a purpose for which differentiated banks have been established, or this purpose actually explains the meaning of differentiated banks in India. These are the banks which have been established for providing a specific type of products or banking services. They are different. These services are different when compared to the existing banks in India. How, what, why? This we'll get to know when we try to understand what are the different types of differentiated banks. Okay, so the purpose of establishing these differentiated banks is to provide specific banking services and products. Then why RBI is promoting these differentiated banks? What is the aim behind, or what is the objective behind having these differentiated banks? The answer is to promote financial inclusion and payment system. This is an important dimension of why we want to have these differentiated banks, in order to promote financial inclusion and payments. How it is promoting financial inclusion and payment, we will again get to know it when we try to understand these different types of differentiated banks. So if you are clear the meaning of differentiated banks as well as the purpose, then let me give you a brief background that how these banks have been established. So guys, there was a Nachiket More committee which was established in the year 2015. I think I forgot to mention it here. There was a demand for having differentiated bank. Differentiated means that a different quality of banks to cater to the specific needs of the individual. This demand for long was there. So in the year of 2015, RBI has established a committee which was headed by Dr. Nachiket More. Usha Tharote was also one of the members of the committee, and guys, this committee recommended that you need to give the license to the differentiated banks. Okay, so this is the background, and guys, please remember the name of the committee. It is quite important. Question can be asked in the examination. And as per the recommendation of this committee, RBI has granted license under Section 22, guys, quite important, again an important section. So they can ask a direct question that under which section differentiated banks like small finance bank or payment banks have been given license. It is under Section 22 of the Banking Regulation Act of 1949. Okay, so guys, this was the background, and on the background as well important questions can be asked. First, the name of the committee as well as which section of the Banking Regulation Act. Now guys, there is one more important fact which you need to know, that these entities have to be registered under Companies Act. So first they need to be registered as a private company under the Companies Act 2013, and then they need to get a license from the RBI under Section 22. 2 of Banking Regulation Act of 1949. So this is the small background or historical briefing regarding the differentiated banks in India. We have already discussed the purpose, we have already discussed the aim, as well as the committee responsible for granting the license, or who was involved in the granting of the license or to these differentiated banks. So guys, we have understood each and everything. Now we'll move on to the types of differentiated banks, and it is quite important, guys. So first type of differentiated banks is small finance bank. And guys, you will now get to know the answer to this question, that how these banks are different from the already existing banking structure in India. Okay. So first is small finance bank. Now we will see what is the scope of activities of these small finance banks. So if we see in an overall view, so there is no much difference in the point of activities of the normal banks and the small finance bank. This bank accepts deposits as well as can provide loans. So this bank is already indulged in lending and depositing activities. So it is quite similar to the already existing banking structure. Okay. So what is the difference? You will get to know it. But first, let us understand the criteria of establishing a small finance bank. So first criteria is, guys, that an individual who is having an experience of 10 years in the finance sector, a non-banking financial company or a microfinance company, local area banks are eligible to set up small finance banks. Moreover, there could be payment banks, which is another class, are also eligible to apply for small finance banks. Okay. So these are the individuals or the entities who can apply for small finance banks. Now there is one more criteria. Let us see. These entities need to have a minimum paid up capital. Guys, quite important question can be asked directly on this fact. Minimum paid up capital of 200 crores. This question has been asked previously many times. And guys, earlier this used to be 100 crores. So don't get confused if you see that, sir, it is 100 crore. Many of the sites still mentioned it as 100 crore, but this has been recently revised to 200 crore. So please remember the latest figure. It is 200 crore. One more fact here is, guys, that if an urban cooperative bank wants to be converted into small finance bank, so there is a small relaxation to that, which is that they can establish with a minimum paid up capital of 100 crore, but this capital has to be increased to 200 in the next 5 years. Okay. So only an exception is urban cooperative banks or primary cooperative societies. If they want to convert into small finance banks, so they need to have a minimum paid up capital of 100 crores in the initial, and they have to increase it to 200 crore by the end of 5 years. So guys, this is the establishment criteria for the small finance bank. I hope each and everything is clear. We have discussed the entity who can establish, individuals or the professionals having 10 years of experience. Then there are certain other entities like NBFCs, microfinance companies. Then we have discussed the capital requirement. Minimum paid up capital requirement is 200 crore. Earlier it used to be 100, but now it has been revised. Then we have discussed the important criteria regarding the cooperative societies. Okay. So guys, now we'll move on to the operational aspect of small finance bank. For the small finance banks, 75% of its adjusted net bank credit to the sectors eligible for the. So first, let us try to understand what this entire statement means. This means that 75% of the adjusted net bank credit must goes to the priority sector lending. This is the first operational aspect. Now, there is a question that might be coming in your mind that, sir, what do you mean by adjusted net bank credit? So guys, if I will go into the details of this term, it will take almost an entire session. So what I will do, I will try to simplify it for you so that you can understand in a much simpler way. Okay. So guys, here it is mentioned bank credit. Bank credit. What do you mean by bank credit? It means the loans or whatever the lendings that have been provided by the bank are known as bank credit. So there is a term which is bank credit, and there are different things like rediscounting of the bills with the RBI. A bank is indulged in different type of operations like rediscounting bills, then it do some investments. So when we adjust all those things from the bank credit, which we already know, it is known as adjusted net bank credit. Okay, this is a very simple explanation of this term. Okay, otherwise it will take almost half an hour to explain each and everything under this term, which is not much fruitful for you. Okay, so guys, we have understood that 75% of the adjusted net bank credit must go on to the priority sector lending. So this is the first criteria of small finance bank. There is no such criteria in regard to this. Guys, yeah, when we discussing the scope of activity, so we are comparing it with the normal banks. So for the normal banks, there is no such criteria like this. Okay, the priority sector lending limit is there, but it is quite less. It is 40%, but here it is 75%. So 1 point of difference. Differentiated banks, how they are differentiated, we are getting to know it. Sorry. Then coming to the next point of difference is, guys, that these small finance banks are also need to maintain CLR and SSR. So this is quite similar to our normal banks. CRR, cash reserve ratio, and statutory liquidity ratio. I hope you are aware of these terms. Then at least 50% of its loan portfolio constitute loans and advances of up to rupees 25 lakh. So at least 25 lakh, or basically the 50% of the loans that this bank is providing must be up to 25 lakh. Okay, so whatever the loan that has been in, suppose 1 lakh, 2 lakh, 3 lakh. So the number of loans that have been sanctioned up to 25 lakh must constitute 50% of its entire loan portfolio. That means, guys, one point important here is small finance banks, as the name suggests, provides small loans. 50% of its entire loan portfolio must comprises of the loans up to rupees 25 lakhs. So this is another point of difference when we compared it with the normal banks in India. Okay, I hope now you can relate it. First point of difference was in terms of priority sector lending, and the next point of difference is in terms of the amount of the loan that can be provided. So majority of loans are small loans, that is up to 25 lakhs. Then, guys, one important criteria of small finance bank is that they cannot have subsidiaries. No subsidiaries. Okay, so guys, these are the entire details regarding small finance bank. As the name says, small finance, so they are providing the loans which are in small quantity. Okay, as not only quantity but as well as quality. We cannot be sure the number of loans, but the quality, which is, it has to be maximum up to 25 lakh. Okay, so guys, this is all about small finance bank, and we have tried to differentiate it from the normal existing banks. That's why these banks are also known as differentiated bank. They are different from the normal banking structure. Now coming to the next class of our differentiated banks, which is payment banks, and it is also quite simple to understand. Just stay with me. So guys, just like we have done in the small finance bank, we will start with the scope of activities in the payment bank as well. So guys, here it is mentioned that rupees 2 lakh something is mentioned here. So what it actually means is that these banks can provide you facility of deposits. . and they cannot provide you a facility of loan. Small finance banks can indulge in deposit as well as lending activity, whereas the payment banks cannot lend you loans. They can have the deposit facility. You can deposit the amount in the payment bank, but you cannot lend. So this is the first point of difference between payment banks and the small finance bank, and actually how the payment banks differ from the normal banking system. Okay. Then the maximum amount of deposit an individual can have in a day is 2 lakh. Now many of you might get confused that, sir, it is 1 lakh. No, it has been recently revised to 2 lakh. Okay, so remember this figure, guys. Earlier it used to be 1 lakh, but now it has been revised by RBI to 2 lakh. Okay. We have already discussed important point of or the scope of activities of payment banks, which is they can have the deposits but they cannot lend. So one important question that can be arise that can these banks provide credit cards? Or can these banks have ATMs? As these banks provide you the deposit facilities, so there is a withdrawal, you can do the withdrawal of your deposit in amount. So these banks provide you ATM facility. They can provide you ATM facility, but as they cannot provide you loans, so they cannot provide you credit cards. Credit cards are not provided by the payment bank. So all the payment banks that have been out there, they cannot provide you credit cards. The logic behind that I already explained it. Now coming the criteria of the setting up the payment banks. Sorry guys, there is small typing error here. It is actually the payment banks. Okay. So first is the minimum paid up capital is 100 crore. In case of payment banks, the minimum paid up capital is 100 crore. Then guys, coming to the operations, like we have discussed in the small finance bank regarding the operation of that bank, in here we will also discuss that as the banks cannot lend, they cannot provide you loans. So what are the operational details that how these payment banks earn money? So guys, as the money has been deposited, so all the deposit that will make into the account, so 75% of that deposit will go into the government securities. Okay, and the remaining maximum 25% or the remaining 25% they can deposit in the other commercial banks and they can earn the interest. Okay, so this is the way the payment banks earn. Okay, other banks, how they earn? They provide the loans and charge interest on that. But in the difference here is that 75% of the deposits they are having will go on in the government securities, and the remaining 25% they can deposit in the scheduled commercial banks. So guys, I hope you have understood the operational differentiation between a payment bank and a normal bank. And this is also indifferent to the small finance bank. So guys, we have discussed the scope of activities and the criteria of setting up a payment bank. Now, yeah, there is one more point guys, that a small finance bank, basically a payment bank can be made into a small finance bank after 5 years. So suppose there is Airtel payment bank which is in existence. So if it completes its 5 years, it can apply to be converted into a small finance bank. Okay. Because guys, that way it can generate more profits. It can indulge into the activities of lending. So that's why most of these payment banks or the cooperative society, they want to convert into a small finance bank, because the only difference between a normal bank and the small finance bank is what we have discussed. One, in the terms of priority sector lending, okay, but still they will earn from the interest which is much more higher in comparison to the investment in the government securities or the deposits if they make into the scheduled commercial bank. So this is the reason why the different type of banks like the payment bank or the cooperative society, they want to convert into a small finance bank. And again, these small finance banks wants to convert into scheduled commercial banks. Why? Because of operational constraints are there. Okay, so they can be converted into scheduled commercial bank, but that also depends on the discretion of RBI. So who is the final authority to decide? It is the Reserve Bank of India. So guys, this is the entire details about the payment banking in India, also payment banks in India. Now coming to what the payment banks cannot do. So guys, we have already discussed that they cannot provide you credit cards, they cannot extend loans, they cannot do cross-border remittances, or they cannot accept NRI deposits. So guys, these are the important factors that we need to remember. Question can be asked on any of these aspects. So guys, before wrapping up our session, there are few things which I want to revise. First, what we have done, we have discussed the differentiated banks. What is the aim, what is the purpose, and the small background that we have already discussed. Then we have discussed the different types of differentiated bank. One is small finance bank, other is the payment banking system in India. We have discussed how they are different from each other, as well as how they are different from the normal banking systems in India. Guys, there is one more point that I would like to add up, that many people around there, they compare local area banks with differentiated bank. So as per the definition, local area banks are differentiated banks. They fulfill all the criteria because local area banks cater to, I think, basically 3 districts in together. So there is a constraint that has been placed on their operations. Okay, so it is actually comes under the definition of differentiated banks. But to have a constant structure, because the term has been coined since 2015 and the local area banks are in existence from the year of 1996. Let me write it. So that's why we keep local area banks separate from differentiated banking. Otherwise, as per the definition and in many of the notification of RBI, they have considered local area banks as part of differentiated banking. So if they ask about differentiated banking, yes, local area banks are part of differentiated banking. But if they say differentiated banks, so as of now, there are 2 types of bank that have license in India. One is small finance bank and the other is payment bank. Now there are new things which are coming up in the future, which is wholesale banking, wholesale banks, or the long-term investment banks, or long-term finance bank, I think the name is, and the other is custodian banks. Let me give you a small gist what these terms actually means. Wholesale banks is basically, guys, that these banks will indulge in not dealing with each and every retail customer, but they will deal with only large corporates. Okay, so that will what wholesale banks will be. But what it actually will be, we will get to know when RBI provides the license for the same. It is only in the draft phase, so they are not in reality as of now. So when they will come, we will include that in our course. Then what do you mean by custodian banks? So guys, these custodian banks are nothing but they are basically the types of bank which try to provide you the service of custody. Basically, if you want to keep the custody of your securities with some of the bank, so like the locker system in the bank, so we are trying to have a special type of bank which will act as a custodian of your assets, securities. Okay, and whatever they will charge on the fee on your custody of having your securities or your assets, that will be the earning of the bank. So this is another special class of bank which will come up. It is right now only in the draft phase, so we need not to worry about what they actually are. We just need to know what these terms actually means. So guys, these are the new types of bank which may come up in the future. Okay, so guys, that's all from my side regarding the differentiated banks in India. We have discussed small finance and we have also tried to discuss a small comparison of differentiated banks, differentiated banking, the local area bank, and the new types of bank that might come up in the future. So guys, that's all from my side. If you like the video, please do subscribe to our YouTube channel, share it with your friends, and do give a thumbs up. I'm your mentor Veer, now signing off.